Derivatives. I've seen people say that there's no faster way to lose money than to start trading derivatives. This is one of the jokes is like when you start trading stocks and then you learn that there are things called derivatives and you learn like what is a put and what is a call and how much these things can move based on how the market normally flows. It moves at a faster rate, and that's what a derivative is. It's from calculus and whatever, right? So you have some curve, and that curve, then you take the first uh, derivative of it, and then its acceleration from velocity and whatever. And so when you trade in derivatives, you can make money much faster. Most people lose money much faster. Lucas, I think what's going on in the market, we have to put this into context, is we did talk about the stock market recently, but one of the things that has been repeatedly said about what's happened with the stock market over the last few years is that even though we've had growth in the stock market, the growth in derivatives has been tremendous. And so there are these side bets essentially. The most basic derivatives are like a put or a call. So a call is you're saying, I want the right to buy a stock at a certain price. So if you are buying a call and the stock is low and the stock goes up, then the price of that call will go up. And if it goes into the money, then it starts to trade at the same rate that the stock does. And that makes sense because if you said I want the right to buy the stock at $30 and the stock is now trading at $35, then you have essentially purchased the stock at 30 because you have the right to buy it at 30. And so you pay a premium on this, so it costs money to buy it. Usually it's some percentage of the stock, sometimes like 10% or something like that. And so then once it goes into the money, you're essentially trading at the price of the stock. So it's a way to trade the price of the stock, buying in much cheaper than actually buying the stock. And then a put is a similar type of thing where you're buying the right to sell the stock at a certain price. And so if the price is going to go down, then you will have the right to sell the stock, even though now the stock is trading at $20 and you bought a put at 30. Now there's a spread of $10. And so you make money. And there are much more complicated ways to do this. There's naked puts, there's naked calls, there's all kinds of different ways that these can work. There's covering and there's futures markets, and it's a whole plethora of different things that you can do in the world of derivatives. And mostly when people start to get into this, they realize that there is a very degenerate way to gamble on the stock market. And Lucas, I don't know how much you've ever played around in this stuff, but most people who try this get crushed. That's the first thing that happens. So the answer to the question is no. You should not trade derivatives unless you really know what you're doing. And you should definitely play in the sandbox or the preview market before you do this, because there's usually ways that you can try things out. You can play with play money before you do it with real money. So you should do that for months or years before you do this with your own cash.
Well, the answer to your question is I have never bought any trade derivatives. Well warned. I'm very wary of trade derivatives, and in part it's because I have maybe romantic notions about a stock market and capitalism being based on the value of companies. But those romantic notions have led me to look otherwise. But I do find the the growth of derivatives and what's happening in the stock market has impact in everybody's life, whether we're playing with them or not. So I'm vaguely aware of the beast of derivatives that is roaming in the pastures of the markets. Um,
So derivatives can cause the market to move extremely fast. So one thing that will sometimes happen with derivatives is you can also do things with leverage. So leverage is where you will start to take on a larger position than you normally would by using some sort of relationship that you have with somebody who has more money than you. So they'll borrow you money to be able to take on a bigger position. But then what can happen is you can get liquidated. And so usually there are these points in the market where there's a lot of leverage or there's a lot of derivative pressure. And these points, if we cross them, like if the price crosses it, then usually something kicks in where it'll liquidate your position because the exposure that somebody who borrowed you the money, they don't want a lot of that exposure. Like they say, well, we're willing to borrow you this money, but if the price goes below this on whatever bet you're placing, then we're going to liquidate your position, and then you'll be on the hook for whatever the delta is that we couldn't recapture. And so then you have to come up with that. And so things can also occur where if it looks like your position is getting very dangerous, then you can get things like margin calls. And so the markets can move really fast, because when you get margin called, what will happen is you can have a forced liquidation of other things in your portfolio to meet your margin call, because whoever is doing this thing with you is usually your brokerage or somebody else that has some financial call on other assets that you've got. So usually you've got a basket of things, different stocks that you have. You make some outsized bet on something you think is going to go the right way. It goes the wrong way, and then a whole bunch of your other assets get forced liquidated, sometimes at very undesirable prices. And so the market can move really fast like this, where some things that occur then cause forced liquidations, and those can be cascading events, which then cause other people's leverage position to get liquidated. And so then the markets can very quickly go in the wrong direction. I think ETH is set up in a situation like this, where some people are saying there's a price of ETH that if it goes below something 1400, that there's $100 million of leverage that is going to get forced liquidated, and that would cause a lot of ETH to get dumped on the market, which would cause kind of a death spiral of ETH to go down. So there's a point at which if ETH goes below it, there could be some serious ramifications. I think Binance Chain was kind of in that same position a little while ago too.
Well, it's interesting, you bring up the lending rates and how the lending rates and leverage trading drive some of this interest in derivatives, because the trades can also move quickly and are not bound by the production of value or products from a company and the returns that they're showing. So when I look at this growth of derivatives, to me, it's correlated or a result of the low lending rates that we have, that are sort of pyramided off of the federal funds rate from the Federal Reserve. So is that do you make that association with the derivatives, or do you find some other reasons being behind this explosion in derivative trading on the stock market?
I think there's a portion of that going on, because if you're going to allow people to take on these positions, the money's got to come from somewhere. I mean, if you're going to go buy 10x the amount of stock that you would normally have, you're borrowing that money from somebody. It's usually your brokerage. And so if you're borrowing that money, the brokerage has got to get it from somewhere. So either they've got other clients that want to put their money to work, and you're usually paying a premium on that money. It's just like any other kind of borrowing. You are paying a percentage. And so if your bet goes well and then you collect your money, then a portion of that goes back to the people who lent the money to you. And then if it goes the wrong way, then you're on the hook for whatever losses happen. And so this is where it can be pretty lucrative to get involved in these derivatives markets, because it's another way to make money lending. As far as does the federal funds rate play into it, I think to the extent that it puts more liquidity and more money sloshing around, because money is fungible. If you can get free money from the Federal Reserve, and I'm not saying most people have access to that, but certain players do. If you can get money there, then you say, well, I can get this money, and so that frees up this other cash to play around to do this other stuff. So if we have tightening of the monetary policy, there's less money to go around to play around like this. So I think to the extent that when there are very loose policies at the Federal Reserve, more money tends to slosh around in the system, and that tends to make borrowing cheaper, and it makes more money available for this kind of stuff. And so, yes, I think it ultimately does lend itself towards there being these big bubbles and assets, and that we see the inflation of stuff like the stock market. So I'm not surprised to have seen, when we had really loose monetary policy, that we saw that the stock market went up very substantially. And as we've had this contracted monetary policy, that eventually we would find the stock market asset bubble deflating in a very substantive way. And whether the tariffs are directly at fault or if this is just the natural, we are overdue for a correction and a contraction because we've had this loose monetary policy for so long.
Well, Trump asked Chairman Powell to lower the funds rate before they had this tariff rollout. So while they were putting, I want to say it was a month and a month and a half ago, Trump asked Powell directly to lower the funds rate, and Powell said no. And this is where we should remember that the Federal Reserve, even though we call it an American central bank, is a private institution and has some degree of autonomy from the political will of especially the president of the United States, maybe less from Congress. But it was interesting to me whenever that happened. I wasn't sure if Trump was going to follow up on this tariff plan or how serious he was about it. But in the wake of Liberation Day, we see that he's pretty serious about it. So it's interesting that he did not get um, a in what should we call it, an insertion or an increase in liquidity coming from the Federal Reserve. And but come hell or high water, without that liquidity, they still went with the tariff plan. So we're seeing the Trump shock in the wake of that. But I I don't know, when you look at the derivative, I should say, the shape of the market today and the amount of derivative trades that go on, do you find this ideal, sustainable? Is this how the market was intended to operate? I mean, do you see problems with it?
Derivatives were supposed to provide a way to normalize prices. I mean, that was what it was originally, I think, discussed, or these are the things that I heard when I was growing up, and I grew up around a bunch of stockbrokers. I mean, this is all these guys would talk about. So I feel like this is my childhood. All I heard was stock trading, this and derivatives, this, that, and the other thing. So, to some extent, if you feel like there's irrational exuberance in a certain stock and you say, oh, well, this stock is not trading on its fundamentals, therefore I'm going to short it. And that provides some amount of valve on this irrational buying because now you have a way to sell stock that normally wouldn't be put on the market. That I think is probably healthy, but when you have market makers who can do things which are very antithetical to free markets, like they are able to create shares and then have time to settle them, and that settlement time can be substantive. You can create really weird market dynamics where you essentially have an insider who is willing to bet against a stock and allow for a situation to occur where you make self-fulfilling prophecies. And private equity has been very notoriously doing this kind of stuff where they will know that they're going to drive a company out of business, or they're going to do something very poor to a company that is currently profitable. They'll take some position on it and then get their hooks into it and drive it into the ground, and their shorting of the stock doesn't ever have to get paid off because when the company gets driven out of business, they don't have to close their short positions. Like the company goes bankrupt and then it doesn't trade anymore. And so therefore they kind of just made money for free. That sort of market dynamic is extremely toxic and unhealthy. So I think if we had market makers that were bound by stronger rules and they had to do things reasonably, then maybe these things would work. But I think the way that the game is set up right now, it's very toxic. It's not, yeah, I don't think it works the way it was supposed to at all. And some of the things that, I think were originally set up for commodities trading, where you could say, I'm going to try to make sure that I can buy something at a certain price so I can normalize my costs over time. That doesn't, that's not how it ended up playing out. Like people ended up using it as a way to bet on things, and it became just this big casino. So I think to some extent we've had market dynamics that have turned the stock market more into something that looks like a casino and less like trading on the fundamentals of companies that are reasonably priced according to the profits that they're making and the dividends that they're paying out. Like we haven't had a stock market look like that in a really long time.
You know, I worry also about the advantage that private equity groups have in a low interest rate on debt world, and I think this is part of the problem that we see in the world today. You know, we have different expectations of disclosure and for public companies and private companies. It seems to me that private companies get away with borrowing a lot of debt and uh, uh, engaging in the market in nefarious ways. You know, manipulating the companies that they're buying the stocks of and trying to kill the companies uh, instead of turn them into something that is providing a benefit to society. So that's in part what I see in the financial market today. I also see the the government benefiting from the volatility in this type of market. Because when the government can say that, you know, the GDP is based on in part on the amount of transactions or evaluations of all of this money that's flowing around in the market, and that's part of our GDP. Um, and are all and the government can also be printing a large amount of debt. I say printing, creating a large amount of debt in order to keep the liquidity high and to keep that going. In some way, the volatility of the market is a relief valve where they can burn off cash, um, but also one that's not that in which I beat this drum all the time. We're not actually making anything. If we're throwing money around in a circle and counting the amount of transactions and say that's an economy, then we are deluding ourselves. And so when I look at Trump's tariff policies and what he's trying to address without the control of the lending rates or the interest rates on debt, then I think what we're seeing is an administration that's trying to change this sort of arc in where the market and where our interest rate monetary policy is gone.
And I think he said something to the effect of that this tariff situation needs to play out for something like at least 2 years. Did you hear that? I seem to recall Trump saying something about the time horizon around which these tariffs need to be in place before we'd see the positive effects. So, you know, the market shock that's happening, whether this is the unwind of a lot of derivatives and the tightening of monetary policy finally coming home to roost, or if this is a direct result of tariffs, seems like tariffs are more being blamed for the tightening of monetary policy, and that tightening of monetary policy has been happening for quite some time.
Um, I did not hear him say that he had some sort of notion of a 2-year window, but I expected, you know, the the defibrillation or the excitement of the market to take some amount of time. You know, it's been interesting to see the reaction in
Here, I
the
pulled it up. I don't. I was like, I did not necessarily saying ABC News is the best place to get your news from, but I just picked the first one that I found here. But I think he did say this, and there was some um, quote. Yeah, here it is directly. Let's say it's a 2-year process. A reporter asked, and this was, I think it was last Thursday that this was said.
Well, and I don't know, one, it's nice to see ABC actually coming with a source and not saying, you know, unnamed, officials in the government. Um, but whether it's a 2-year process or not, I think what's more important is that this will be a negotiable process. I mean, Trump came out with the tariffs that they're going to be assessing on foreign countries of the world, but immediately also had a table for negotiation for them to come and have discussions about what tariffs and reciprocal tariffs might look like, or tariffs from the other countries. So I think that is in part about what is maybe more important is we're getting off of if we're getting off of this pouring more dollars into the world economy to keep it going. Part of that needs to be a redressing of what the trade relationships between various countries are, and it seems that rather than jumping to green, the other markets of the world said, "Oh, um, maybe we're getting off of magic money. Maybe, maybe there has been a artificial inflation or uh, artificial or unreal exuberance in these markets." And
Well, and as far as you saying, like, we don't make anything, it's one thing that has been a big part of our economy and has been a substantial component of it is the defense industry. I mean, we've been manufacturing planes and bombs and all kinds of stuff. I mean, this is one of California's biggest industries. When I was, the early part of my career, I found my way into this and quickly wanted to get out of it because I didn't want to make these types of things anymore. As I kind of realized what I was engaged in. It was making automation equipment for the defense industry, and I've never seen bigger manufacturing facilities in my life where you've got all these planes lined up, like out in California, places like Lockheed Martin and Northrop Grumman. I mean, they're making planes, they're making bombs, they're making all kinds of stuff, and that is directly manufactured in the United States. Now, whether every single piece of that is componentized here, we used to have that stuff. I mean, Texas Instruments and Silicon Valley, and we used to have a substantial amount of this stuff even through the 90s. So it's really been, I don't know, in the last 20 years that some of that stuff has started to substantively go overseas. But all of these things were here in a big way. I mean, remember Dell Computer, and remember what was it, Gateway? I mean, these things were here. They were onshore. They were made in America.
a Dell computer hasn't gone anywhere. It's still in Texas. Um,
Texas Instruments is gone, though. I mean, like, this
Texas.
stuff was here. I mean, it's within our recent history that we've had a deindustrialization of the United States. So to contemplate whether these things could come back, I think it's there's supply chains that need to be in place to make it happen, because you don't just make these things in absentia. You need the little resistors and transistors and all kinds of stuff to make these chips function. I mean, even a hard drive has a little computer chip on it. I mean, these things are all, complex. And when you start to lose major end manufacturers, you lose the suppliers, because now they're like, well, we don't have anybody to sell to, and they get undercut from the Chinese, and that drives those people out of business. And so I think it was the top individual at Apple who famously said this, that even if they wanted to make stuff in the United States, it's the supply chains and the design houses that are critical that don't exist here. So if we want to have that stuff, like, we have to have all the base component manufacturers that need to be in place as well. So it's a long process if we're going to reindustrialize here.
Well, it's not an impossible process, and I have seen disdain from various people who say, Americans don't. There's even Chinese memes now of Americans sitting at sewing machines, and people question, do Americans want to return to factories? Do they want to uh, y- y- do they want to uh, do they want to make chips? Do they want to be manufacturers? I would say the answer is you can have a very different experience in factories, whether it be making shoes, textiles, or sophisticated computer chips. And regardless of what those experiences are like, at some point it becomes necessary for if we're honest about the requirements of defense or autonomy from relying on other countries in the world, then we need to have some of that capability here in the United States, and we gave it up, yeah, since the 90s and the globalization of trade, um, and part of that globalization of trade was also that we figured out it was very easy to make money instead of making other things, and we could convince the rest of the world to play in our game of making money, of making United States treasuries, and they wanted to play in that game too. But that came at a cost to us, and it's time to return to a world where we're making things.
Seems like a lot of empires go through that I mean, that's certainly what happened with Britain. Britain went through a very similar type of thing where, they eventually found themselves at the top and kept gravitating towards the thing that made them the most money, which was to control the flow of money and to control the way that the financial markets work. And the problem with anything like that is you find yourself as the parasite on the top of the system, on the top of the chain, and the people who are making this stuff and the people who are real contributors to the economy eventually realize that they can do it without the parasite, and then they jettison you, and that's the real dangerous spot to be in. So if Trump can pull this off, if he can actually bring manufacturing back, then that's substantive. But I think some of these things actually started under Biden. Biden passing the CHIPS Act and getting Taiwan Semiconductor to come to Arizona, that was massive. I mean, that was not a small feat to actually make that occur. And I mean, we're making chips here in America for the first time in a long time. We had a new plant there, and some of the ways that cars are produced is a direct result of policies that are put in place by the government that says they have to be manufactured here or else the cost is higher. And so if you want to compete, you still got to have manufacturing in the United States. I think Toyota was one of the biggest manufacturers of cars, and they had to do it in America because there were certain regulations that were put in place that said if Toyota wants to sell a car into the U.S. market that's competitive, then it has to do a certain amount of manufacturing here. And it's sub-assemblies and whatever, and that these things are complex, but it's still the case that, there's the auto industry, which famously needed to be bailed out when things went poorly just in recent memory. So I think there is still a possibility that this could occur, but I think this idea that there's going to be a lot of humans sitting on the line, and I've said this before, I don't think that's realistic. I think at least it's going to be done with automation equipment for sure, and that there's a lot of support that goes around that. So humans doing things around that until we get more of the humanoid type robots or real just full automated facilities that can produce things, and humans really aren't involved in manufacturing, I think is the future.
Well, I think there'll be a narrative about safety and monitorization, and if humans aren't actually doing the work, or Americans aren't going to be doing the work, there's going to be some expectation of their presence and them engaging in that process of manufacturing here. And you bring up a good point with the UK. After World War II, the American policies were aimed at destroying the British and French empires, and what we made them give up was their preferential trade that they had with their colonies, because they had set up these colonies around the world and set up puppet governments in them, and then said, and we get the cheapest rates from the things that you produce or the resources that you're mining in your countries. So it's what I also look at China's response to the movements that we've been making, and it goes back before Biden and the CHIPS Act. Trump, in Trump's first administration, there was the big fight with Huawei, and that was a beginning or realization and political movements towards bringing back chip manufacturing here into the United States. So, but the other thing before we close out that I wanted to bring up was there's going to be a second act with regards to Trump's tariff policies, and that's going to be the tax cuts that he's promising. He's promising getting rid of the IRS, getting rid of income tax, and probably certainly relieving some of the tax burden on corporations, whatever that looks like, payroll tax or capital gains tax, whatever it may be. So it will be interesting to see what the markets look like in the wake of those tax breaks, and what they balance out with. What the companies who are publicly traded, where they're located, and what their evaluations look like, but also what sort of market activity exists in the ecosystem in a world that has maybe a little bit more government control on tariffs, but more a more rounded ecosystem here inside the United States. So that's all I had to talk that I wanted to bring up today on markets. I don't know if you had anything else that you wanted to add.
I think it's a great place to stop, and we'll see you next time on FOMO.